Today, the meaning behind the numbers. The DFA Daily to the 4th of October 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. In today's show, we look at the latest loan and deferral data, a new set of unemployment numbers, we'll remember Melbourne's unfortunate record, and touch on investor confidence and how the super rich may handle their affairs. But first, the value of new home loans declined by 4.3% in August as owner-occupier lending fell amid ongoing COVID-19 restrictions. This is based on new data from the ABS that showed the new home loans totalled $30.7 billion in August. That's 4.3% less than a month before. The total was mostly dragged lower by owner-occupier loans, which were down by 6.6% in August to $21.2 billion. That's the largest fall since May 2020. But the ABS said that despite the fall, the value of loan commitments was still 34% higher than the year before and 53% higher than the pre-COVID levels back in February 2020. The largest falls for owner-occupier lending were in states with greater lockdown restrictions. For example, New South Wales saw a fall of 9.6% to $7.2 billion. Victoria was down by 4.9% to $6.3 billion, and the ACT fell by 11% to $502 million. There were smaller falls in Western Australia, Tasmania, and the Northern Territory. In the Northern Territory, owner-occupier loans slipped by just 2% to $125 million, while Tasmania was down 5% to $269 million, and Western Australia declined by 3% to $1.9 billion. But Queensland rose by 2% to $3.9 billion, and South Australia was up 1.8% to $1.1 billion. The average loan size for owner-occupier dwellings, that's including construction, the purchase of new dwellings and existing dwellings, dipped slightly at the national level and across most states, with the exception of New South Wales, where it hit a new record high of $732,000. In the contrast to the downwards movement for owner-occupiers, the value of new investor loans continued to increase. It was up 1.5%. to $9.4 billion, with unbroken growth since October last year. The value of investor loan commitments was 92% higher compared to a year prior, and the highest since the record level recorded by the ABS in April 2015. Increased investor loan commitments were seen across most states, particularly in Queensland, up by 13.6% to $1.8 billion, Western Australia up 7.2% to $530 million, and Victoria up by 1.9% to $2.5 billion. New South Wales recorded the largest fall, though, by 3.2%, down to $3.7 billion. And first home buyer loans continued to fall in that rotation towards investors. Notably, the number of new loan commitments to owner-occupier first home buyers saw its 7th consecutive fall, dropping by 3% from the month before to 12,547, and that's 2.1% lower than the year prior. It was the first time there was a year-on-year decline over the 2 years, the ABS said. First home buyer owner-occupier loans during the month came to $5.5 billion. That's 4.9% less than the month before, although it was still up by 11.2% year over year. Similar to the value of owner-occupier commitments, states and territories with greater lockdown restrictions had the largest falls in the number of first home buyer loan commitments, the ABS said. New South Wales saw a fall in owner-occupier loans for first home buyers by 11.5%, to 2,874 in total. Victoria was down by 3.8% to 3,777, while the ACT fell by 12.7% to 288. Only Queensland and Western Australia recorded rises, up 1.3% to 2,531 and 3.7% to 1,789 respectively. But refinancing, on the other hand, across all home loans was up by 3.2% to a record high of $17.8 billion. For owner-occupiers, refinancing slipped by 1% during August, down to $11.2 billion, while investor lending rose by 11.5% to $6.5 billion. And that shows, of course, that people are still trying to find those cheaper loans out there, a way of alleviating some of the financial pressure. Meanwhile, in personal finance, the value of new loan commitments for fixed-term lending was down by 2.5% in August to $1.9 billion, and that was dragged down by a 6.4% decline in vehicle loans. So you could argue, I think, that the top is off when it comes to mortgage lending, and the rate of change from this point will probably ease back a little. That will translate possibly to lower home prices ahead rather than higher, but we will see. Elsewhere, Roy Morgan's unemployment figure of 8.7% for September was over 4 percentage points higher than the current ABS estimate for August, which was at 4.5%. But the ABS figure for August counts as employed an additional 248,900 Australians who were working 0 hours for economic reasons, and 371,300 Australians who were working 0 hours for other reasons, such as being forced out of work by mandatory lockdowns. If those 620,200 non-workers were added back to the ABS unemployment estimate for June, that would actually take it to 1.24 million, or 9.1%, and the ABS also claims that there's nearly 1.27 million Australians, or 9.3%, underemployed, for a total of over 2.51 million unemployed or underemployed, which is 18.4% of the workforce, and that's a very similar estimate to the latest Roy Morgan unemployment and underemployment estimate. Underemployment was also down in September despite increasing part-time employment. In addition to those who were unemployed, 1.16 million Australians, 8% of the workforce, were underemployed, working part-time but looking for more work. That's a drop of 12,000, down 0.2 percentage points from August. And in total, 2.43 million Australians, or 16.7% of the workforce, were either unemployed or underemployed in September. That's a drop of 108,000 on August, and overall, total unemployment and underemployment was at its lowest since March 2020, at 2.16 million, just prior to the start of the pandemic. And compared to early March 2020, before the nationwide lockdown was implemented in September 2021, there were over 260,000 more Australians either unemployed or underemployed, that's 1.1 percentage points, even though overall employment at 30,308,000 is still higher than it was pre-COVID, when it was 12,872,000. And Michelle Levine, the CEO of Roy Morgan, said the latest Roy Morgan employment estimates for September show unemployment falling 0.8 points to 8.7%, and the measure is now at its lowest since February 2020 at 8.3%. However, the drops in unemployment over the past 2 months, driven by declines in New South Wales and Victoria, are not a true reflection of the labour market. With more than half of Australia's population currently in lockdown, the workforce increased in September, but it is still well below its level in June 2021, before the current lockdowns began in Greater Sydney. Driving the increase in the workforce was a rise in part-time employment, which increased in both New South Wales and Victoria and was up by 373,000 to over 4.6 million nationwide. In contrast, full-time employment was virtually unchanged from a month ago. So it's worth reflecting on this, that the true unemployment rate is way higher than the artificially low one reported by the ABS. I think the Roy Morgan data gives a much better read as to what's going on. Elsewhere, the Australian Prudential Regulatory Authority released new data on temporary loan repayment deferrals for August 2021 amid the coronavirus pandemic lockdowns, and that revealed that a total of $11.9 billion worth of loans, or 0.5% of total loans outstanding, are on temporary repayment deferrals. But deferrals rose from $5.6 billion, or 0.3% of total loans outstanding in July, but they have remained at a significantly lower level than at the height of the COVID-19 crisis in mid-2020, when they peaked at around 10% of total lending. While the previous COVID-19 repayment deferral period expired in March, with some lenders ceasing acceptance of new deferral applications, banks began offering temporary financial assistance again to borrowers affected by the COVID-19 crisis and the latest round of lockdown restrictions. In August, APRA extended regulatory relief for COVID-related loan deferrals and released the final version of its prudential standard outlining regulatory support for loans impacted by COVID-19, which include a temporary prudential treatment for loan deferrals. It said that banks with total loans subject to deferral above a minimum threshold of $50 million and 50 facilities will also need to report data on the loans under reporting form ARF 932.2. Furthermore, under the regulatory relief, banks will not need to treat a repayment deferral as a period of arrears or loan restructuring, whether or not the borrower has previously been granted a repayment deferral. Deferrals were highest in New South Wales. The data showed that housing loans comprise the majority of deferrals and have a higher incidence of deferral, with 0.7% of those loans subject to deferral at $10.8 billion, compared to 0.3% to SME loans at $765 million. New South Wales had the highest proportion of deferred loans at 1.4%, which is not surprising given the extended lockdowns and restrictions on business operations, compared with the rest of the country at 0.3%. But this difference tightened in August, APRA said. The prudential regulator has also compared deferred loans to total loans across three cohorts: loan-to-value ratio of greater than 90%, investor loans and interest-only loans, to provide an indicator of potential elevated risk in deferred loans. Deferred investor housing loans comprised 34% of total housing loans, while interest-only loans comprised 14%, and LVR of greater than 90% comprised 7%. Out of total housing loans, investor loans comprised 36%, interest-only loans comprised 14%, and LVR of greater than 90% was just 5%. And as at August 31, housing loan deferrals in New South Wales made up 1.4% of total housing loans, up from 0.7% in July. The proportion of deferrals also increased in Victoria, up from 0.2% to 0.4%, the ACT up from 0.03% to 0.36%, and Queensland was up from 0.04% to 0.23%, and South Australia was up from 0.17% to 0.23%. Marginal increases were recorded in the Northern Territory, up from 0.06% to 0.15%, Tasmania up from 0.03% to 0.06%, and Western Australia up from 0.02% to 0.05%. SME loan deferrals as a share of all SME loans also increased in New South Wales, up from 0.16% to 0.65%, Victoria from 0.02% to 0.16%, and Tasmania from 0.01% to 0.08%. South Australia was up 0.01% to 0.05%. While there were no SME loan deferrals in July in Queensland, the Northern Territory and Western Australia, deferrals increased to 0.07%, 0.06% and 0.02% respectively in August. And the proportion of ADI investor loan deferrals was higher. Data submitted by ADIs with over $50 million in loan deferrals has revealed that the share of investment loan deferrals out of total housing deferrals is significantly higher than the other two cohorts. For example, while Macquarie Bank reported that while housing loan deferrals comprised 0.5% of total housing loans, investor loan deferrals made up 45.1% of total housing deferrals, while interest-only loans comprised 24.3%. Across the major banks, Westpac reported that investor loan deferrals comprised 38.3% of total housing deferrals, while interest-only loans comprised 14.2% and LVR greater than 90 was 5.3%. The CBA reported the highest proportion of total housing loans in deferral as a share of total housing loans out of the ADIs that provided the data to APRA at 0.9%. Investment loan deferrals comprised 31.8% of total housing deferrals, while interest-only comprised 15.9% and LVR greater than 90% comprised 10.7%. And at National Australia Bank, 0.6% of housing loans were in deferral in August, with investment loans comprising 34.4% of deferred loans, while interest-only loans comprised 7.7% and LVR of greater than 90% comprised 4.6%. Point here, of course, is that the deferrals are much harder to get this time around, whereas last time they were pretty much handed out to anybody who asked. And it is worth noting that deferrals relating to investor loans are a lot higher. That's consistent with our surveys, which indicates the likelihood ahead of more investors deciding to get out and sell their investment property, particularly if you're in the higher risk areas of high-rise, where a lot of high-rise vacancies exist and values are still falling rather than rising. Now, just in passing today, Melbourne has become the most locked down city in the world, with 246 days living under stay-at-home orders and surpassing the previous record of the Argentine capital, Buenos Aires. In fact, Melbourne will far exceed that record as the city's lockdown continues, with restrictions not expected to change until the end of October, when 70% double dose is achieved. But the Victorian Premier, Daniel Andrews, hopes the halving of the Pfizer vaccine interval from 6 weeks to 3 will help speed up the process, and he urged the state to make a final push before lockdown ends. We're going to get past this. We're going to end this lockdown and open up, and all that we will enjoy when we do will be a result of all that we've given up, he said on Sunday. Investor Daily reported that State Street Global Markets' latest Investor Confidence Index, the ICI, which measures investor confidence or risk appetite quantitatively by analysing the actual buying and selling patterns of institutional investors, reported a 4% drop from 109.9 in August to 105.9. The European ICI attributed most of the dip, which fell by 9.2 points to 95.6, while North American ICI also fell by 4.4 points to 106.1. Meanwhile, the Asian ICI fell just a little bit, dropping 0.8 points to 97.7. State Street Global Markets senior macro strategist Marvin Lowe said that despite the hit, the global ICI has remained near its highest level in 3 years. Resurgent infections from the Delta variant have resulted in lowered growth expectations globally, although the economic backdrop continues to look attractive for above-trend growth in 2022, he said. Additionally, numerous central banks, including the Fed, have indicated that they will slow asset purchases in the coming months, with some expected to wind down their QE operations by mid-2022, which may provide an ongoing headwind until the timeline for rate hikes become clearer. State Street's report comes after data found that global activity in August also dipped due to rising COVID cases throughout Europe. Last month, the European market experienced a 25% decline in deal volumes compared with July as infections rose, while other regions saw spikes. A global data lead analyst said the surge in new cases had left investors concerned, while the World Health Organization anticipated around 236,000 COVID-related deaths in the region by December. And finally, more than 400 Australians have been named in a massive leak of offshore company and banking details, which has revealed secret investments, real estate deals, and artworks of celebrities, politicians, and business figures who control more than $1 trillion in assets. The documents, the largest leak of offshore files in history, identify at least 14 current heads of state and 21 former heads of state, among a total of 330 politicians who control offshore trusts and companies, including Czech Prime Minister Andrej Babis, former British Prime Minister Tony Blair, and Jordan's King Abdullah. The Australian Tax Office says in a statement that will be analysing the information to identify any possible Australian links. Close associates of Russian President Vladimir Putin are among 130 billionaires from 45 countries who appear in the files, which cover 14 of the largest offshore firms that administer nominee companies for wealthy clients in low-tax jurisdictions. Their clients range from celebrities, including Indian cricketer Sachin Tendulkar, singer Shakira, supermodel Claudia Schiffer, actress Monica Bellucci, and Spanish tenor. In 2019 and 2020, 11.9 million documents, known as the Pandora Papers, were leaked to the International Consortium of Investigative Journalists and shared with 600 journalists and 150 media organisations around the world, including the Australian Financial Review. We're not talking about millions of dollars here. We're talking about trillions of dollars, the ICIJ Director Gerard Ryle said. Deputy Tax Commissioner Will Day, who heads the Serious Financial Crime Task Force, told the Financial Review that we're aware that the ICIJ is today reporting that they've released data referred to as the Pandora Papers, but there are a range of legitimate reasons that some may have for an offshore bank account or structure. We know most Australians do the right thing. However, the leak underlines the reputational risk that Australian business figures can face in their legitimate use of conventional offshore structures in jurisdictions like the British Virgin Islands, only to discover that their service providers' client lists include figures accused of serious crime or corruption. But the point more generally I want to make is that over the last few years, the very rich have got ever so much richer, partly because, of course, what's happened with the quantitative easing, but also perhaps because they have more access to more sporty structures, including tax shelters and offshore structures, than ordinary people. So their effective tax rates are often a lot lower, and whether that's criminal or not, I'll leave others to judge. But of course, the truth is that the rich have got so much richer, while everybody else hasn't. And yet that does seem to be stitched into the way the economic realities work at the moment, and central bank strategies are part of the problem, as well as neoliberalism and the way that political parties drive their policies. This is, to my mind, an intentional situation because many of the politicians are themselves in the rich group, so they're looking after themselves. And as more information comes out on these papers, we may well discover more issues. But the point is this, that of course many of them are pushing the current law to the limit and are still completely legal, and yet objectively and morally speaking, they are probably already over the line. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Repayment Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.